Good afternoon. I want to thank everybody for logging in and calling in today to listen to our webinar on what can you do with your old 401k account. So we'll talk today about some of the options you might have if you have an old 401k or even some old retirement accounts, not necessarily a 401k specifically, but other employer-sponsored plans. What might you be able to do with those accounts that your maybe traditional brokers and your banks don't really have to offer you? My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I'm a member of the Florida Bar, so I'm a licensed attorney. And we'll talk about a few legal issues possibly today, but I can't give legal advice. I can't draft any legal documents for any of our clients. But I've been with Advanta now over 10 years. During that time, I've seen a lot of different transactions. I've worked with a lot of people who have money in an IRA, have money maybe in an old 401k account, looking to diversify and to do something different within their particular retirement account. Just a quick disclaimer, some of the things we don't do at Advanta. We don't give any legal, tax, or investment advice when it comes to an individual looking to use their IRA, use their old 401k to buy real estate or to buy into a private placement, other types of assets like that. We can't give legal, tax, or investment advice specifically to them. Now we can refer you to a CPA, refer you to an attorney, someone that can help you make that decision. We can only really advise you of the circumstances and the different aspects of self-direction in general. So you're encouraged to consult with your own attorney, your own accountant, your own financial advisors to decide if an investment makes sense from a legal perspective, a tax perspective, and also if it just makes sense in general and it's something you were looking to do. Our company's been around since 2004. We have what I think we have our advantage over some of the competitors that we have in the industry is that we have a local feel, and that a lot of the people that work with us feel a better connection to us simply because we have an account manager program by which every client, every new client, every person who signs up gets assigned to one person in our office. There's one person who will be able to help you regarding your investment, answer any questions you might have on your account, and give you a much more personal or local feel in working with, like I said, working with our particular office. Now, the only thing we do at Advanta is administer and do record keeping for qualified money, basically IRAs, old 401ks, those types of funds. The only ones we can hold are these basically the IRS would consider to be qualified money. We can't handle any non-qualified funds. If you had money in a personal savings account, in different regular general brokerage account, we can't handle those funds. They do have to be what the IRS considers to be a qualified funds, which, like I said, would either be an IRA or some type of old employer-sponsored plan. Now, a lot of people who have money in these types of retirement accounts are limited, or at least believe they're limited to certain investments, basically, that those banks, those brokerage firms sell. So whether you're invested in one of those institutions, you might have the ability to choose from a variety of mutual funds, a variety of different CDs with different terms, etc. But IRS regulations do allow for you to invest in quite a number of different things. It's up to each custodian to decide what they're willing to hold. So a brokerage firm makes a decision that they want to hold mutual funds, that they want to hold stocks. They could allow you to do other things, but they have that right and that ability to simply say, this is what we're going to hold within our retirement account that we administer. At Advanta, because we don't sell any products, we don't sell a CD, we don't sell real estate, we don't sell mutual funds, we will allow you to invest in whatever it is that you feel like you would want to invest in. And simply, our job is to make sure that it happens in the correct path and the correct order to ensure that your IRA stays compliant from a tax perspective. So it's IRS regulations allow for a very broad range of investments. It's your individual custodian that may be limiting you to what you can invest in if you stay within their platform. When you look outside of that particular custodian, you'll see there's a lot of other different things that you can invest in. Now, some of the main reasons I think people look to alternative assets. We'll talk about predominantly today real estate, private lending, investing into private placements, investing into commodities and foreign currency exchanges. People are looking at these types of assets, I think, for three main reasons. One, for some, it's simply a new source of capital. If you're looking at investing in a rental property and you already own rental property personally, but you're looking to acquire more, your IRA or your old 401k account simply becomes a new source of capital for you, a different bag of money that you can pull from in order to acquire more particular assets. Or if you're looking at investing in a private hedge fund or a private placement, you don't have any money in your savings that you're willing to part with, but you have funds in a retirement account, that can then be used instead as a different funding source, again, just simply a new bag of money. For some clients, the decision is somewhat of a tax decision. When you invest with your retirement account, whether it's an IRA or a 401k, your earnings come back into the account either tax deferred with regular accounts or tax free if you were to have a Roth IRA, which we'll talk about a little bit later. But so some clients make that decision. If I'm going to make this investment and it has plenty of potential to give me great returns currently, well, personally, if I made this investment, I might be looking at a steep tax bill. But if I instead do this investment through an IRA, a tax deferred entity, I can end up saving taxes by doing that. So for some clients, it's a tax decision. Fair number of others, though, the reason why they're looking to self-direct is simply that they want to be in control and they want to feel safer about what their retirement accounts are invested in. You have only so much control when you put your money into mutual funds, you put your money into the stocks that are traded publicly. Being able to choose a particular asset, whether it's, again, a private placement, whether you're doing your own foreign currency trading, whether you're investing in a piece of a rental property down the street from where you live, you have much more control over that investment, and in general, people feel safer about this type of investment. Now, as far as the types of assets that we see in a self-directed account, people investing in real estate, whether it's raw land, whether it's commercial property, residential, could be a condo, could be a duplex, could be something they're looking to do as a long-term rental, could be something they're looking to do on a short-term basis. The great thing about when you're buying in real estate is it doesn't matter what type of real estate it is, you can purchase it. Now, there's some restrictions on what you can do with that property that we'll talk about a little bit later in the presentation today. We also see a number of other clients invest in paper assets. People invest, making a mortgage loan from your IRA. Your IRA is a lender. Somebody borrows money from your IRA. They sign a promissory note. They sign a mortgage back to your IRA. Or whether you don't use collateral and you do it as an unsecured note, there's a lot of different assets you can create with paper. Different contracts, different agreements, different joint venturing arrangements that you can do with paper. Again, your IRA can make these investments as well. We see a number of other kind of general alternatives, people investing their retirement account, their old 401k, putting it into an LLC, one that maybe they have a direct control over. They call it a checkbook control LLC. We'll talk about at the end of today's webinar. Could be you're investing into a private placement. Again, somebody who's raising money, raising capital for a new business venture. Your IRA buying in, or your old 401k buying into that particular private placement as an LLC. Also see people investing in farm animals, partnerships, movie projects, precious metals, wanting to buy physical gold and silver within their retirement account. Again, a lot of different alternatives outside of the stock market, outside of the mutual fund market, where most people, again, believe they have to have their funds held, because when you're investing with a brokerage firm, they're not going to offer you these lists of alternatives that we've just talked about. They're going to basically pigeonhole you or make you invest in those particular assets that they sell. So what types of accounts can be self-directed? Any type of IRA, whether it's a traditional or a Roth, kind of an individual retirement account, whether it's a STEP or a simple you have through your employer, or maybe you are your own employer and you set up a SEP or a simple IRA, and being able to contribute more money each year into your account than what you would be allowed to with a traditional or Roth. We do have solo or individual 401k plans for self-employed individuals, but the one kind of category we're going to talk a little bit about here in just a few minutes, a little bit more at length, and ties into the title of today's webinar, are really these former employer plans. Your 401ks, your 403bs, your 457 plans, your pension funds, etc. We'll talk about those because a lot of times that gets missed. People hear the word self-directed IRA and think, well, if I don't have an IRA, That's not something I can be invested in. But if you have that old employer's plan, you have the ability to move the money out of that plan and into a self-directed IRA without any tax consequence, and in turn make these particular investments. Now, as far as other accounts that can be self-directed, education, health savings accounts as well, not retirement accounts like the rest of the accounts listed on this slide, but they do follow the same set of rules and have similar tax benefits that we'll talk about today. So moving money, how do you move money between these accounts? That's, again, another concern that we hear a lot of times people have. They're a little scared of how this movement of funds are going to go because they don't want to trigger a taxable event. They're not wanting to pay tax on this money. They simply want to use it to buy a different type of investment. Luckily for us, the IRS has put a couple different mechanisms in place to move money from one retirement account to the other. The first is by doing a transfer, which is from one IRA account to another. It goes directly from trustee to trustee. That's why it's called trustee to trustee transfer. It goes directly from one IRA with one firm to an IRA account at another firm. Doesn't touch the client's hands. It's thus a non-taxable and non-reportable event. Another way to move funds would be a direct rollover, and this is when we're talking about former employer plans, the 401ks, the 403bs, etc. To move money out of that old employer's plan into an IRA, you would do a direct rollover. And your administrator of that former employer's plan will send a check or send funds directly from that account into an IRA, again, without you touching the money. As long as you never touch the funds personally, you do not have a taxable event. So you can move money from one IRA to another, from an old employer's plan into an IRA, and not have to worry anything about tax consequences. Now, I've met with people in the past that have been confused by that, or even those whose own financial advisors who are not familiar with self-direction in buying real estate, for instance, in an IRA, felt that they were going to have a taxable event. But if you're looking to make those investments and you have accounts, they're an IRA, they're an old 401k, you can move that money without issue into a self-directed account. It's important to note as well that the transfers, direct rollovers, and any earnings within an IRA account are unlimited. Now, the IRA accounts, generally speaking, differ based on how much you can contribute out of pocket each year into them. But as far as that reason, you can transfer money between accounts, and you can earn as much money within those accounts as you wish. There is no limitation on that. All right, so again, the title of today's webinar is What Can I Do with My Old 401k? Again, tied to that, really, again, 401k being a moniker basically for us to talk about any employer-sponsored plan. A lot of the four we'll see as we go through the titles, they have relationship to certain sections of IRS code. For instance, Section 401, subsection K, is what we mostly associate as, we talk about as a 401k, but a lot of people associate with the retirement plan in this system. 401ks are basically defined contribution plans that allow for the employee that's involved in that 401k to defer a portion of their salary each month or each year into the plan, and then their company, their private company, can do a profit sharing match on top of that. So again, individuals who are in the private sector working for a business, a lot of them have a 401k through their current employer where they defer some of their salary and the company matches. Now, they're called, the difference here, a defined contribution plan, in that the company is electing to define what contribution they will make for you. So the company might say, we're going to match 3% or 5% or 10% of your salary deferral each year. So they're going to tell you, here's what we are going to put into the account for you. It's up to you to then grow it. And we'll contrast that with a pension plan at the bottom here in just a moment. So a 401k is a defined contribution plan for private companies. A 403b is a similar type retirement plan, but it's for, generally speaking, public education employees and some nonprofit organizations as well. So, for instance, a school teacher might have a 403b where they can defer some of their salary, and the school board or the county can match a portion of that as well. Now, 457 is, again, just another code section from the IRS, are other deferred compensation plans for other governmental employees. One of the main differences a 457 plan has over the other plans we're talking about here and IRAs as well is that you can pull money out of a 457 plan prior to 59.5 without having a 10% penalty. In general, with IRAs, Roth IRAs, 401ks, 403bs, etc., if you pull money out of those accounts prior to 59.5, the IRS levies a 10% penalty against you for pulling that money out as an early distribution. Again, 457 plans don't have that requirement. You can keep the money in, or you can take the money out, I believe at age 55 without that 10% penalty. But again, the 457 is another, again, deferred compensation plan, meaning that instead of receiving salary for $100,000 in a given year, you might defer $10,000 of that into a 457 plan and only end up with $90,000 of income that you have to pay income tax on in a given year. A TSP plan that's abbreviated for Thrift Savings Plan, those are also defined contribution plans, again, very similar to a 401k, but these are set up specifically for United States civil service employees and members of our military. So we see a lot of former veterans with TSP plans. We see a lot of postal workers as well with TSP plans that can all be rolled over into a traditional IRA account. And again, the four accounts we've talked about so far are more of a defined contribution plan where you're putting a certain amount in. Contrast those with the pension plan. Now, we don't see pension plans as much anymore because pension plans are a defined benefit plan. Back in the 50s and 60s, a lot of people would have a pension plan through their employer where their employer guaranteed them a certain amount of income per month or per year upon that employee's retirement. Now, because the company was defining the benefit, saying we will pay you, for instance, $500 a month once you turn age 60 or whatever the age might be, it was up to the company to make sure that when that employee turned that particular age, that they had enough money in the defined benefit plan to meet that, or in the pension plan to meet that benefit each month. That's why we've seen in the last couple of decades, more companies switch to the 401k. Companies were concerned about not being able to meet the benefits that they had told employees or promised employees with the pension plan. So they switched gears in the last few decades to do the 401k again, where they'll tell you how much they will put into the plan, and then it's up to you to invest it. So they're not on the hook down the road. So it's really one of the main differences that we had seen a shift from pensions to 401k plans over the last few years. So what type of IRA can I move my old employer plan into? Well, for a lot of people, the decision can be a simple one. If you have a couple $100,000 in an old employer plan, you can just do a direct rollover into a traditional or a SEP IRA, and there's no tax consequence. The 401ks, 403bs are all considered pre-tax accounts, just like the traditional IRA, meaning that you will pay tax down the road when you retire, but you've got the benefit of some tax deductions up front. So to move the money from the employer plan into a traditional or SEP IRA, there's no tax consequence, moving it from like account to like account. The other option you would have would be to move that money from an employer's plan into a Roth IRA. Now, a Roth IRA stands apart from the other retirement accounts we talk about because a Roth IRA, ultimately all the income that's being generated inside that Roth is accruing tax-free to an individual rather than simply tax-deferred. So with Roth IRA accounts, you make contributions into the account, you pay taxes up front on that money, meaning you don't get any deductions, and then the account's going to grow on a tax-free basis going forward. If you have money in a pre-tax IRA like a traditional or a SEP, you can move that money into a Roth IRA by doing what's called a conversion. You take money in the traditional IRA, you move it over to the Roth, and you pay taxes the year that money is converted. So if in 2016 you move $20,000 from your traditional IRA to a Roth, you will pay taxes then on $20,000 when you file your 2016 tax return. So that $20,000 that's now in the Roth is going to start growing and accumulating tax-free. So if you have an old employer's plan, and when you're doing your direct rollover, you may have the option, if your employer gives it to you, to simply roll that money into a Roth IRA and to basically treat it as a conversion. So if you roll over $100,000 from your old 403B into a Roth, you're going to get a 1099 again for $100,000 this year and pay the taxes accordingly. Going forward, that account's growing tax-free. If you're thinking about doing a conversion, that's a situation where a CPA is worth their weight in gold to help you make that decision as to whether it makes sense for you to do a conversion or to do a direct rollover into a Roth IRA account. They can look at your tax situation, what bracket you were in this year, what bracket you might have been in last year, to help you make that educated decision. One thing we like to caution people about is never to take this money out of the account. If you're looking and basically buy an asset in your personal name, if you're looking at making an investment, buying a piece of rental property, for instance, if you take the money out of your IRA, you take the money out of your 401k to buy that house, to buy that rental property in your personal name or in your personal LLC, you're going to lose a substantial amount of money to taxes and possibly penalties by pulling that money out. And this slide really is somewhat is the genesis of a self-directed IRA account. By being able to move the money from an old 401k into an IRA, or from IRA to IRA, and then invest in real estate, you preserve that capital from one account going to the other. So if you were to take that money out personally, you're going to pay taxes and possibly penalties when you pull that money out, and pay taxes and pay taxes as well on the income that property generates. If instead you bought this property within the IRA and transferred this $100,000 in this example to an IRA account, you preserve, there'd be no taxes due on that transfer. When the IRA buys the property, there'd be no taxes due then. Ultimately then, all of the assets are accruing then, tax deferred or again tax-free if it's a Roth, back into the retirement account. So again, this slide really is kind of the genesis again of self-directed IRAs, why you want to keep that money protected, tax protected, inside an IRA account or inside an old 401k. Now we talked again about some of the possible alternatives, and there really is a long list of investments you can make out there. And the IRS, when creating IRA accounts, thought that it'd be much better and easier to simply list a couple things that you would not be allowed to do within a IRA account, a couple of investments and a couple of people you can't transact with. So when IRAs were created in 1975, there was no master list drafted by Congress. They simply said a couple things that you can't do within your IRA. And the only two investments you cannot make in an IRA are you can't buy life insurance and you can't buy collectibles. And that's it. Collectibles would include your artwork, antiques, alcohol, collectible stamps and coins, things of that nature. So the IRS said simply, these are the only things you can't buy. Whether it's a mutual fund, a stock, a piece of rental property, a private placement, investing in your friend's company and getting private stock back, all of that is going to be allowed as long as you're not buying life insurance and you're not buying collectibles. Additionally, they put a restriction on who your IRA could transact with or who could receive any type of benefit from the asset held inside your IRA account. That's important when you think about when we go over who disqualified persons are, to remember that your IRA is its own separate, distinct legal entity. And as its own legal entity, your IRA is prohibited from transacting with you as the IRA owner, your spouse, your parents and grandparents, your children and grandchildren, and any business or entity that is owned or controlled by one of those parties. So the IRS simply says you're going to buy real estate, you're going to invest in private notes, you're going to invest in private businesses. You can't be investing or transacting with any of these disqualified persons, nor should any of these individuals get any type of benefit from the asset held inside your IRA account. People are surprised to find out that brothers and sisters and aunts and uncles and cousins are actually not disqualified persons. So your IRA can transact with them. We would caution that you still want to do so on a fair market or arm's length basis. If you're transacting with a brother or sister, you don't want to invite any scrutiny that the deal is a wink and a nod as opposed to an honest business transaction. So prohibited transaction then simply involves your IRA, a disqualified person, and one of the people we just listed, and then a transaction going on between the two, where your IRA and the disqualified person are on opposite sides of that deal. If your IRA is buying a property from you personally, that would be prohibited. You're on opposite sides as a buyer and seller. Or your IRA looking to lend money to someone who's disqualified. Again, opposite sides of that deal. Now, it is possible to partner your IRA with a disqualified person where both your IRA and the disqualified person are sitting on the same side of the deal. We'll go through a case study of that here in just a few moments. Again, just some other things to consider about the prohibited transactions. Again, brothers and sisters and other family members should be dealt with on an arm's length basis. You cannot use a middleman between your IRA and a disqualified person. So you can't just insert your friend Bob or insert your friend Susie into the middle of that disqualifying transaction. That would still be prohibited. And importantly, the use of the IRA-owned asset for yours or any disqualified person's benefit or enjoyment. So if your IRA owns a piece of real estate, you and your disqualified persons are prohibited from actually using that particular property. Lastly, if your IRA owns an asset, there's going to be some sweat equity needed, some maintenance on a piece of real estate. Your IRA does need to pay a third party simply to do that work. Doesn't matter who that third party is, it's as long as they are not a disqualified person. Now, as we go forward, we're going to go through a couple of case studies and really illustrate how the process of self-directing your IRA works. Actually, what's involved, what Advanta does as the administrator of the account, and what the client does and what the client is responsible for as well. In this first case study, we have very simply an individual, John Smith, who's a former postal employee, has a TSP plan, had that thrift savings plan with over $300,000 in it, and he's looking to roll over just $30,000 to a traditional IRA and then to go acquire some property. So he would open up his account with Advanta, filling out our paperwork to get an account established. He would then contact the government to get the right TSP form that he would fill out and send back to them requesting a $30,000 rollover to a traditional IRA that he's setting up with Advanta. And it's going to be up to John Smith to find the property and write the contract in the name of the IRA account. Again, in Advanta, we talked about at the very beginning with the disclaimer, we don't sell any products. We don't sell real estate. We don't sell private placements. It's up to the client to find the property and decide what he wants to buy. And when he does identify this property, we would help him make sure the contract gets written in the name of his IRA account. That's very important to demonstrate to the IRS that this property that he's buying for $25,000 is indeed an investment being held within his IRA. He would complete a purchase authorization form telling us what he's buying. I'm buying this particular tract of land. Here's the attorney or title company that is handling the closing. And our job will be to work with that company or work with that attorney's office to make sure that the verbiage, the Advanta IRA for benefit of John Smith's IRA account appears on all the closing documents, it appeared on the contract, and then also make sure that John Smith reviews and approves all these documents for us prior to closing. So before we will sign a contract, before we ultimately will sign any closing documents on behalf of the IRA, we will make sure that John Smith has reviewed and approved all the documents for us first. So he's going to need to look over the HUD statement, the deed, et cetera, make sure everything is what he wants it to be. Ultimately sends us back his approval. We will then sign the closing documents and wire funds to the closing. Now going forward, if he was able to sell this property in just a few months later, the profit he's going to earn within that particular, from that investment, comes back into his IRA tax deferred. Okay, the earnings again that accrue to an IRA account accrue without any tax consequence. So outside of an IRA, because this happened in less than 12 months, he'd be subject to a short-term capital gain, which is taxed at ordinary income. And depending on his bracket, he could be paying 25, 30% on the gains that he made within that particular investment. But because this money is coming back inside an IRA, it simply comes back in the area. The full $40,000 comes back into his IRA with no tax consequence. He's got the funds back into the account and ready for his next investment. Now the next deal is an example I mentioned. There are certain disqualified persons your IRA can't transact with being on the opposite side of a deal. But here's a situation where we have two disqualified persons who are on the same side of a transaction. This is kind of what we're talking about, partnering, individuals being able to partner their IRA up with other disqualified persons to make the same deal. And just kind of an example here to show how that process would work. So Paul and Linda are husband and wife, and they each have an old 401k plan. They worked for a company for a number of years, left employment there, rolled the money out, or had the ability to roll that money out into another plan, into an IRA to make a different investment. They have some money in each of those accounts, but their property they're looking to buy, looking to, again, also invest in some rental properties. The property they want to buy is more than either one of them has within their own retirement account. So Paul and Linda look to do a joint purchase where both of their IRAs, both of their retirement funds will be used on the same particular deal to buy this property from a third party. So Paul and Linda would each, again, open and fund their Advanta account, so filling out our paperwork to open the account and then requesting a rollover from their old custodians, their former employer's plan, into an IRA account with us. Once the accounts are open, they find the investment property, and just like we saw in the last example, they're going to make an offer to purchase, only this time, instead of listing just one IRA, they're going to list both of their IRA accounts on the particular contract. They would submit a form to us, again, the same purchase authorization, but Paul would submit one, and Linda would submit one as well, each saying that they're going to buy 50% of the property alongside their spouse's IRA account. Our job, again, will be to make sure that all of the closing documents show both of their IRAs on title and make sure both Paul and Linda, again, have read and approved those documents before ultimately we will sign the documents and send the wires funds towards closing. So when they're writing the contract and then ultimately writing the deed and all the closing documents would show Advanta IRA for benefit of Paul's account as to a 50% undivided interest, and Advanta IRA services for benefit of Linda's IRA as to a 50% undivided interest. This demonstrates that this is not Paul's IRA buying 50% from Linda or Linda buying 50% from Paul. It's both of their IRAs together buying a 50% interest from the particular seller, who's a third party. So it's very important the deed would be listed as a tenants in common. So both of their IRAs buying, and the percentage that's going to be listed is based on how much is going to come from each different IRA account. In this particular instance, both Paul and Linda had the same amount of money in the account, made sense to do it as a 50-50 partnership. If you were looking at partnering, though, with your IRA and some third party or even somebody else who has an IRA account, you can have different percentages. So if in this case, Paul's IRA had substantially less than Linda's, then they wouldn't want to do a 50-50 deal. They'd have to do it and structure it according to how much comes from each different IRA account. So it's the percentages are based on that, no more and no less. They're husband and wife. In this case, it's 50-50 again, only because they're putting in equal amounts into the account. Now going forward, so we've helped them purchase the property, make sure it got titled correctly, had the contract, and ultimately got closed in the correct name as well. Going forward, since this is a rental property, there's going to be some ongoing expenses. The repairs, the initial repairs they need to make on the property to get it ready to rent. Any maintenance, any ongoing maintenance, the property taxes, the insurance, any expense associated with that property must be paid then from their two IRA accounts and be paid, in this case, based on the percentage of ownership. So if a property tax bill comes in for $2,000 next year, $1,000 would come from Paul's account, $1,000 would come from Linda's account to pay that particular bill. Our job at Advanta will be, if you send us those bills, we will receive them, get those paid out of the account, and then likewise, any income that's generated. So Paul and Linda go out and find a tenant that's paying $2,000 a month in rent. That $2,000 rent check comes into our office, and we then split that. Deposit $1,000 into Paul's account and $1,000 into Linda's account. So our job as the administrator and record keeper is to initially make sure the property gets titled correctly, and then once the property is purchased, make sure as well that the income and expenses flow between the flow in and out of the IRA account. In this case, again, based on the particular percentages of ownership. So that's our primary function as the administrator. We're not telling Paul and Linda what property to buy or who they should rent to or who they shouldn't rent to, how much rent they should charge, etc. It's all those decisions will be up to Paul and Linda. Our job is to facilitate the purchase and facilitate all of the administration that will go along with this type of asset. Our next case study, we have Laura. Laura has an old 403B plan. She's a school teacher, and she's actually currently working with the school board, but she was able to take withdrawals because she was over the age of 59 and a half. Now, we've talked a lot about former employer plans today, because once you are no longer working at a particular company, you have the right and the ability to move that money regardless of your age. But if you are still employed there, so if you're still working for the company that you have your 401k with, or in this case, Laura is still working for the school board and has the 403B, they can place some limitations on your ability to do rollovers. Most accounts allow, though, once you reach 59 and a half, to be able to roll that money into an IRA account. So Laura is able to take that withdrawal or do that direct rollover because she's reached 59 and a half, but she's a school teacher. Okay? She's busy from 6 in the morning to 6 at night, going to work, grading papers, etc. She doesn't have the time or the ability to go out and find a piece of real estate, rehab it, fix it up, manage it, etc. But she does know that other people do that and can make good money at it, and they're always looking for additional sources of financing. So she meets Ray. Ray, someone who's rehabbing a house, or who's rehabbing probably many houses, but always looking for more funds for his particular deals. Laura, Ray says, I have a new deal coming up. I need about $80,000 or so to get this property purchased, properly fixed up, and I should make a decent profit on it when I get it sold. Laura said, that sounds like a good idea. Let me look into it a little bit and how I can do this. Ray tells her, hey, well, if you have money in an IRA account or you have money in an old employer's plan, that money could actually be used to make this particular deal. Before Laura decides to open up an account with us and roll funds in to make this particular deal, she's going to want to do her due diligence. Look at Ray as an individual, run any kind of credit report, credit checks. Also do due diligence on the property itself as well. Okay, she's looking to lend $80,000 to Ray. She wants to know who he is and what kind of guy is he to make sure she's going to get paid back. And also, if she's lending $80,000 on this property, is the property even worth 80? Or what Ray's told her, does it seem to make sense with what she knows? So it's up to her to perform that due diligence. She's satisfied, and she offers to lend him the $80,000 from her IRA account. When you're doing private lending, so in this case, Laura's IRA is not going to buy the property. Ray's going to be the actual one on title. Laura's going to simply open up the account with us, roll some funds in, and then have us lend the money and have her IRA hold the note and the mortgage. So her IRA is going to stand in the place of the bank to receive basically the payments that Ray's going to make. So when Ray has a monthly mortgage payment, it's not going to go to a bank, it's going to go back to Laura's IRA. When the mortgage finally pays off and the property sells, those payments that pay off is going to go back into Laura's IRA. As the lender, Laura sits in that place basically that the bank would in deciding how much she's willing to lend, basically how much is he going to borrow, what the interest rate might be, what the length of term is, when is this loan going to mature and be fully due and payable. Is this loan going to be amortized? Is it interest only? Are there any equity participation terms? Basically, is she looking to get more than just an interest rate and maybe get a piece of the upside of the property or do some joint venturing alongside of Ray? This particular client structured the deal as such. They had $80,000 loan with a 6% interest rate. So typically, rehabbers who are rehabbing houses might pay 9, 10, even 12% for a hard money loan to buy this particular property. But what Laura did a little bit differently was lowered the interest rate, but asked Ray to give her 25% of any of the profits. So anything that property sold over and above the $80,000, her IRA would get 25% of those particular profits. So Ray ended up with a low monthly payment of $400, again coming back into Laura's IRA each month. He writes a check. sends it to us, we deposit it to her account, and she got a first mortgage on the property. So it's secured, so if Ray wasn't able to pay or something happened, where he skipped town, project wasn't going well, she wasn't getting paid back, Laura would have the ability to have her IRA foreclose on and take back the property. Maybe not an ideal situation, but still a possibility nonetheless. That's kind of one of the last strategy we'll talk a little bit about today, and I certainly invite you to call or email us with additional questions after the fact about other investments that you might have in mind. But the strategy they refer to in the industry as having checkbook control. And checkbook control typically involves an individual setting up an LLC or a limited liability company in which the sole shareholder, the sole member of that LLC, is their IRA account. So instead of having Advanta go and buy real estate and go through a real estate closing or go through a loan closing in the last example, clients looking to get checkbook control would instead prefer to be able to receive all the rents, pay all the bills, make all their investments, and have more direct control over that asset. Using a checkbook control LLC is the way they accomplish that. Again, setting up a brand new LLC, limited liability company, naming themselves as the manager of the LLC personally, the one who will be able to sign the checks, pay the bills, etc., make investments. And then their IRA is listed as the 100% owner or member within that particular LLC. We have seen some people do checkbook control using a trust, but for the most part, it tends to be people using an LLC to get what they would call true checkbook control. What this allows, again, the individual to do is they have, going back to our example with John Smith at the beginning, if he had the $40,000 he wants to roll over from his old CSP plan, he rolled that money into Advanta. Instead of having us go through the closing process and buying the property, he could instead instruct us to send that money into an LLC that he creates and have us basically have his IRA buy 100% of the shares. And then going forward, he as manager of that LLC would be able to buy the raw land in the name of the LLC. If he were to receive any income, that would come back into the LLC bank account. Any expenses associated with that property would be paid out of the LLC. Or you could see Paul and Linda do this similar type deal where their two IRAs become the members in the LLC. They name themselves as manager and can receive their rents back into the LLC bank account and pay any bills outside of that LLC as well. So again, what this is giving the individual who chooses this is simply more control over the funds. That's why they call it a checkbook control IRA. You see it referred to as a checkbook IRA or a checkbook LLC, but it's giving the individual IRA owner more authority over their particular funds. Now, we encourage you, if you're looking to set up this type of structure, you want to be the manager. We don't require, but we recommend that you speak with an attorney or someone very knowledgeable about this structure to give you the proper advice on how to set it up and how to operate that LLC as well. If you're going to be the manager, you would have to use the LLC. If you did elect to use a trust, you need to have a third party acting as your trustee. Now, the court case this industry is kind of based on, the checkbook control, was a case of Swanson v. Commissioner back in 1996, where Mr. Swanson set up a brand new corporation, named his IRA as the sole shareholder, moved his IRA funds from the IRA account into the corporation bank account in exchange for the shares that were issued to his IRA, named himself as president of the corporation, and from there was able to direct the corporation to make different investments. But ultimately, the benefits and the income that are accruing would ultimately be accruing back into the IRA account that he has established. That court case has been around since 1996. There's been a few other decisions and tax court memos since then to help support the fact that your IRA can invest in this type of structure and have you act as a manager. The IRS was not happy about this in 1996 and it challenged Swanson. The tax court held that it was not prohibited per se for him to act in that manager capacity and have his IRA invest into that structure. However, a lot of people I think have read a lot into this case. And it kind of been a free-for-all to some extent. In fact, there was another a tax court memo issued back in 2013 where there have been advisors out there, and people suggest if you set up this type of structure, you can own your own business through it by doing a checkbook control IRA. You can pay yourself a salary, etc. And one of those taxpayers who took that advice was challenged by the IRS. And the IRS said, again, you can't be the manager, and you can't pay yourself. And the tax court actually said, no, he could be the manager, but the fact that he was paying himself was the problem. So that's one of the reasons we would encourage you to get good advice, if you're not familiar with this, from an attorney, from a CPA, someone who's knowledgeable, to make sure you set this LLC up correctly and that you operate it correctly as well. But the advantages to using this checkbook control, really, for a lot of people, is that control aspect. Being able to write the checks as needed if you're buying a property at the courthouse steps, that can be, using the checkbook can be make that transaction happen much easier, much more quickly. For some clients, it's having a degree of anonymity. Having the name on the deed will not be your IRA account. If you go back to the example with John Smith and with Paul and Linda, the titling was Advanza IRA for benefit of John Smith's IRA account. If you're using an LLC or trust, the name on the deed will simply be the name of your LLC or the name of the trust. So people searching public record may not be as easy to find you. But if anonymity is your only concern, we can title property without using your name and simply use your IRA account number. But again, for a lot of people, using the checkbook control is a matter of having that control to write the checks as needed, and they can hold more assets within their IRA and pay lower fees. We charge just one flat fee to hold each asset in the account. If you're buying multiple properties, you might have multiple different fees. If, though, you use the checkbook control, we consider that to be the one asset of your account. So your IRA invests into the LLC, you simply pay us one fee each year, even if the LLC goes out and buys different types of assets. Throughout the course of the year, throughout the course of many years, you're simply paying us that one low fee each year. So that's some of the advantages of those particular structures, but kind of the disadvantages. Now that you're in control, now you're the manager of this LLC, you're responsible for the record keeping, receiving the rent, paying the bills, making sure that your LLC is staying compliant, that you're following the rules regarding your IRA and an LLC. Your IRA, even if it invests in a checkbook control, still has to follow the same rules we talked about either. You can't buy collectibles, you can't transact with certain disqualified persons, and if you're the manager of the LLC, it's going to be up to you to make sure that your checkbook control entity is following the rules in regards to that structure. If you instead were having Advanza record keep your account, if you came to us and told us you would like to buy a piece of real estate from your son, we would tell you that's prohibited. But if you're using a checkbook LLC and you don't think to ask that question in advance, you could end up again doing something the IRS could be considered prohibited. So the fact that you're maybe not following the rules, or if you're just not keeping good records of all the rents, all the income, the expenses that go out of the account, that could be another cause for concern with this type of structure. When Advanza record keeps the asset, we have a clear record of all the monies coming in and all the monies going out of your account, should the IRS ever look into it. But getting started is fairly simple. It's just opening up an account, filling out our paperwork, funding the account by doing either a rollover from one of those old employer plans or doing a transfer from an IRA. Now, one thing we like to say to make it easier, if you're looking at making an investment, if you're deciding that I do want to invest in real estate, which a lot of people come to say, I've made the decision, I no longer want to have all my money in stocks and bonds, I want to invest in something different. Get an account set up. You can transfer, roll over just a little bit of money to have your account funded and open so that when you do identify that particular asset, to be able to jump at that point and make the investment from the get-go in the name of your IRA account. So you're putting an offer on a contract on a property, getting that property already titled in the name of your IRA account. So again, we find that to be beneficial for a lot of individuals. Get the account open, get a little bit of money moved over to have it funded, and then ultimately tell us what it is that you want to invest in. And our job from there going forward will be to make sure that it gets properly titled and do all the record keeping associated with that as well. But for more information, my contact information is on this last slide. If you have any questions, please just email me, give me a call. I'll be more than happy to walk you through that. You can also visit our website at advanceira.com for other upcoming events and seminars that we have. They're always free. Anything we do with our clients is going to be free for either clients or non-clients. Free education, free networking events, free webinars, and a lot of other just really good information on our site in general. And you're certainly more than welcome to call us at any time. Again, at our main number, which is 727-581-9853 or 800-425-0653. Ask to speak with us. We'll be happy to walk you through your transaction, let you know of any potential pitfalls to avoid, and certainly answer any other questions that you have on self-direction in general. So at this time, I'll conclude the webinar. Again, thank everybody for logging in and calling in today, and hopefully we look forward to hearing from you.